Ladies and gentlemen, a warm welcome to Unit 16 of Module C, Value at Risk, VAR. VAR is considered as a unified risk measure and a new benchmark for risk management used by bankers in different fields. In this chapter, we will discuss Introduction. What is VAR? Application of VAR. Uses of VAR. Building blocks of VAR. Methodologies for computing VAR. Limitations of VAR. Extreme value theory. Stress testing VAR. Back testing. Market risk is defined as the volatility of unexpected outcomes, which can represent the values of assets, equity, or earnings. It arises from the uncertainty of future earnings resulting from changes in market conditions. Example, prices of assets, interest rates. In order to measure the volatilities in earnings or value of trading book exposures, VAR uses standard statistical techniques such as probability to predict worst-case loss. Let us now understand VAR. VAR is defined as the predicted worst-case loss at a specific confidence level. Example, 95% over a certain period of time. Example, 1 day. Under normal trading conditions, it is the maximum loss which can occur with X% confidence over a holding period of T days. If a daily VAR is stated as Rs 1 lakh to a 95% confidence level, means during the day there is only a 5% chance that the loss will be greater than Rs 1 lakh. Correspondingly, there is 95% probability that the loss will be equal to or less than Rs 1 lakh. In contrast with traditional risk measures, VAR provides an aggregate view of a portfolio's risk that accounts for leverage, correlations, and current positions. VAR, however, applies not only to derivatives but also to all financial instruments. As a result, it is truly a forward-looking risk measure. Furthermore, the methodology also can be broadened from market risk to cover other types of financial risks. The elegance of the VAR solution is that it works on multiple levels, from the position-specific micro level to the portfolio-based macro level. Let us now look at the application of VAR. First, VAR itself is a risk measure. Given probability, level P, and specified holding period, larger VAR number would indicate greater risk in a portfolio. Thus, VAR has ability to rank portfolios in order of risk. VAR can be used to apprise senior management of the risks run by trading and investment operations. It gives a numerical maximal loss, probabilistic, for a portfolio. Banks use VAR to set position limits for traders and business units. Systems based on VAR methodologies can be used to measure other risks such as credit, liquidity, and operational risks. This leads to a more integrated approach to the management of different kinds of risks and to better budget planning and strategy. VAR number is useful to determine the regulatory required capital for banks' exposure to risk. VAR is now used increasingly to allocate capital across traders, business units, products, and even the whole institution. Let us now see the uses of VAR. Click on each tab to know more. Financial institutes. Banks with large trading portfolios are particularly prone to high level of risk. Institutions dealing with numerous sources of financial risk and complicated instruments are increasingly adopting VAR method to measure and manage risk. Regulators. First, determination of minimum required capital is now made more risk-sensitive, also more scientific than earlier. Second, there has been an expansion in coverage of risk events in banks' portfolio. The prudential regulation of financial institutions requires the maintenance of minimum levels of capital as protection against potential loss. The Basel Committee on Banking Supervision and Reserve Bank of India and other regulatory bodies have converged on VaR as a benchmark risk measure for computation of regulatory capital. Non-financial corporate. Centralized risk management is useful to any corporation that has exposure to financial risks. Cash flow at risk analysis can be used to tell how likely it is that a firm will face a critical shortfall of funds. Asset managers. Institutional investors are now turning to VaR to manage their financial risks. Asset management companies, mutual funds, hedge funds are able to assess total capital at risk on a portfolio basis by asset class and by individual manager. Sovereign users. A VaR analysis would induce countries to consider hedging foreign currency liabilities, lengthening debt maturities, and taking other measures to reduce risk levels. Let us now see assumptions of VaR. Stationarity requirement. That is, an X% fluctuation in returns is equally likely to occur at any point in time. Random walk assumption. Day-to-day fluctuations in returns are independent. Thus, a decline in returns on one day of X% has no predictive power regarding returns on the next day. Another straightforward assumption is the non-negativity requirement, which stipulates that financial assets with limited liability cannot attain negative values. Distributional assumption. The daily return fluctuations in any portfolio follow a standard normal distribution with a mean of 0 and a standard deviation of 100 BP. Let us now see the building blocks of VaR. Click on each tab to know more. Choice of time horizon. The horizon is set by the user. Time horizons of 1 day to 1 year are used by bankers. The choice of a time horizon is defined by the liquidation period, that is, the time required to liquidate a portfolio. Commercial banks currently report their trading VaR over a daily horizon because of the liquidity and rapid turnover in the trading portfolios. One of the major considerations for determining the time horizon is that the holding period should correspond to the longest period needed for an orderly portfolio liquidation. Confidence level. Select the degree of certainty required, which is the confidence level that applies to the VaR estimate. The choice of the confidence level reflects the degree of risk aversion of the company and the cost of a loss exceeding VaR. Higher risk aversion or greater cost implies that a greater amount of capital should cover possible losses, thus leading to a higher confidence level. For example, if the VaR number is being used to decide how much capital to set aside to avoid bankruptcy, then a high confidence level is advisable. Obviously, institutions would prefer to avoid likelihood of bankruptcy to the maximum extent. Historical database. The next requirement is the requirement collating the historical data of market price changes required for computing the probability distribution. The potential move in each instrument, that is, each risk factor, has to be inferred from past daily price movements over a given observation period. The main assumption underpinning VaR, and which in turn may be seen as its major weakness, is that the distribution of future price and rate changes will follow past variations. VaR model can be constructed with the help of many approaches: parametric, historical simulation, Monte Carlo simulation. Parametric method involves estimation of VaR with equation that specifies parameters such as volatility, correlation, delta, and gamma. As a convenient, although oversimplified, starting point, we can regard this framework as underpinned by the assumption that daily PL or returns obeys a normal distribution. The normal distribution refers to a family of continuous probability function described by the normal equation. The graph of the normal distribution depends on two factors: the mean, the standard deviation. The mean of the distribution determines the location of the center of the graph. The standard deviation determines the height and width of the graph. all normal distributions look like a symmetric, bell-shaped curve. A probability density function, PDF, gives a complete representation of possible random outcomes. It tells us what outcomes are possible and how likely these outcomes to happen. Probability density function, PDF, it helps to answer two basic questions. The first are questions about likelihood or probability. We specify the quantity or quantile and then ask about the associated probability. The others are questions about quantiles. We specify the probability and then ask about the associated amount or quantile. For example, what is the maximum likely profit or loss at a particular probability level? Every normal curve, regardless of its mean or standard deviation, conforms to the following rule. About 68% of the area under the curve falls within one standard deviation of the mean. About 95% of the area under the curve falls within two standard deviations of the mean. About 99.7% of the area under the curve falls within three standard deviations of the mean. The standard normal distribution is a special case of the normal distribution. It is the distribution that occurs when a normal random variable has a mean of 0 and a standard deviation of 1. The normal random variable of a standard normal distribution is called a standard score or a z-score. The above table, for instance, states the quantiles alpha for standard normal deviate. To find the number of standard deviations away from the mean for a given confidence level C, say 95% confidence level, the table shows that this corresponds to 1.645 standard deviations below the mean. More generally, downside risk can be measured by the quantiles of the standard normal distribution. Quantiles alpha, also called percentiles, are defined as cutoff values Q such that the area to their right or left represents a given probability C. The probability of a loss greater than 1.645 standard deviation is given by the area under the curve to the left of the vertical line marking of x is equal to minus 1.645. Conversely, we can say that the maximum likely loss at a 95% probability level is 1.645 standard deviation below the mean. This value can then be described as the value at risk, VAR, of our portfolio at the 95% level of confidence. Let us now look at steps in computing VAR. Step 1. Compute the mark-to-market position of the portfolio. Step 2. Measure the variability or the standard deviation of the risk factor. Step 3. Set time horizon. Step 4. Set confidence level. Step 5. Report worst potential loss. Let us now look at the formula for daily VAR at specified confidence level is equal to mark-to-market position into alpha, quantile corresponding to the required confidence level, into standard deviation. Compute the VAR of a Rs 100 million equity portfolio over 1 day at the 95% confidence level and 99% confidence level if standard deviation of daily returns is 2.5%. Time scaling of volatility. You may need to time scale VAR estimates, for example, when converting a daily VAR to a 10-day horizon regulatory VAR standard. A commonly used method is the square root of time scaling, which roughly extrapolates 1-day volatilities as well as 1-day VAR to longer horizons. Weekly volatility is equal to daily volatility into root 5 equal to daily volatility into 2.24. Let us now see the historical simulation method. The non-parametric approach, such as historical simulation (HS), possess some specific advantages over the normal method, as it can cope with all portfolios that are either linear or non-linear. The method captures the characteristics of the price change distribution of the portfolio as it estimates VAR based on the distribution actually observed. HS should be applied when one has very large data points to take into account all possible cyclical events. Let us now see computation of VAR with the help of historical simulation method. There are 5 steps involved as mentioned below. Tabulating daily changes in risk factors identified for a given portfolio over say last 500 days. Revaluing the current portfolio based on changes in risk factors for 500 days. Plotting the distribution of portfolio values. Sort the portfolio value from the best to the worst. Determine VAR by identifying the required percentile corresponding to the required confidence level. Let us now look at the Monte Carlo simulation method. This method calculates the change in the value of a portfolio using a sample of randomly generated price scenarios. Here, the user has to make certain assumptions about market structures, correlations between risk factors, and the volatility of these factors. It is a 3-step process as described below. Step 1. Listing of all the risk factors and their dynamics, that is, the parameters required to know their distributions such as volatilities, correlations, mean reversion factors for interest rate processes, etc. Step 2. Constructing time paths, that is, simulation is not done over the time horizon chosen in one step. It is performed over a smaller period and the results obtained are used for the next period and the process is repeated until the target period is reached. Step 3. This would be one path. Like this, several paths are constructed to obtain a set of values for the risk factors for each security in the portfolio that are used as inputs into the pricing models. The process is repeated for a large number of times to generate the distribution. This approach can accommodate any distribution of risk factors and can be used to model complex portfolio, but it demands resources and is highly computer intensive. Let us now see the limitation of VAR. Click on each tab to know more. It's important to realize that all 3 approaches for measuring VAR are limited by a fundamental assumption that future risk can be predicted from the historical distribution of returns, which is not always true. The parametric approach assumes normally distributed returns, which implies that parametric VAR is only meant to describe bad losses on a normally bad day. VAR also has its drawbacks. As a risk measure, VAR estimates can be subject to error. That VAR systems can be subject to model risk, that is, the risk of errors arising from inappropriate assumptions on which models are based, or implementation risk, that is, the risk of errors arising from the way in which systems are implemented. VAR model suffers from risk of errors arising from inappropriate assumptions on which models are based or implementation risk. Implementation risk is the risk of errors arising from the way in which systems are implemented. Let us now see extreme value theory. Click on each tab to know more. The most important criticism of VAR method is that the majority of the parametric methods use a normal distribution approximation. Extreme value theory, EVT, is a means to better capture the risk of loss in extreme but possible circumstances. EVT is the statistical theory on the behavior of the tails, that is, the very high and low potential values of probability distributions. After estimating the maximum loss in terms of VAR methodology, it becomes important to consider the residual risk beyond this maximum. EVT involves estimating the conditional distribution of the excess beyond a very high threshold. Stress tests are designed to estimate potential economic losses in abnormal markets. Stress testing combined with VAR gives a more comprehensive picture of risk. There are 4 basic steps for stress testing. Click each tab to know more. Step 1. Generate scenarios. The most challenging aspect of stress testing is generating credible worst-case scenarios that are relevant to portfolio positions. Step 2. Revalue portfolio. Revaluing a portfolio involves marking to market all financial instruments under new worst-case market rates. Step 3. Summarize results. A summary of results should show expected levels of mark-to-market loss or gain for each stress scenario and in which business areas the losses would be concentrated. Step 4. In addition to summarizing the effect on the present, a comprehensive analysis could estimate longer-term, indirect effects on a firm's well-being. Backtesting models are designed to reflect reality. Backtests compare realized trading results with model-generated risk measures, both to evaluate a new model and to reassess the accuracy of existing models. Banks using internal VaR models for market risk capital requirements must backtest their models on a regular basis. We have come to the end of Unit 16, Value at Risk, VaR. Thank you.